And today I'm joined by our esteemed guests, Blake Taylor, who's a VP and a macro research analyst here at First Citizens Wealth. Blake's background started at Ziff Brothers, where he was a senior economist. And prior to that, he worked as a research assistant at the Federal Reserve and Goldman Sachs' macro research group. Today, he conducts research and analysis across global markets and economies for First Citizens Wealth. In addition, to my left, we have Amy Wu Martin. Amy leads Menlo's consumer technology and gaming practice, and in reading her bio, I can almost feel my parents being disappointed in me in real time. Her prior stints were at FTX Ventures, at Lightspeed Venture Partners, and at Insight Venture Partners. Her most illustrious past investments include Susoba Studios, Epic Games, Faraway Games, We, and Alchemy. And if that wasn't enough, she also has an operating background where she was CFO of Discovery Global's digital and sports portfolio. And again, focus on the consumer technology and gaming practices today at Menlo Ventures. For context, Menlo Ventures is a $6 billion venture capital firm founded in 1976, investing in seed through growth stage companies across sectors. SVB actually has the pleasure of banking more than half of Menlo's active portfolio. Their notable investments include Uber, Roku, Poshmark, PillPack, and Tumblr. Now, the intent of the conversation today is to prepare all of you for the type of fundraising environment that you are going to be leading into at some point over the next 12 months. We'll open up the workshop with Blake's comments on macroeconomic insight. And there is a little bit to be discussed there, given the spiraling that we've seen over the last 2 weeks. And then Amy is going to help kind of paint the picture together on what is happening between public markets and private markets that is going to be impacting you and this endeavor that you're undertaking in the next 12 months. So, but that being said, not a normal time in markets. We saw gigantic sell-off in the equity markets, and then treasury yields also start to trade up. Can you paint the picture for us a little bit about what's going on right now?
Yeah, absolutely. Let's have a conversation about where things stand with the trade policy outlook right now, and then we'll transition that into how that affects markets and specifically VC and fundraising world to try to make this applicable to this audience. And I'd like to start by talking about the very big picture of U.S. international trade and tariff policy. I'd like to do that by taking the longest history possible of looking at these trends. So this exhibit that I've prepared for us here goes all the way back to the founding of the US. And each of these bar charts shows what the tariff rate was on average for all goods that came into the United States. A tariff is a tax on imports. So we can break this down into roughly 3 phases. The first, from the founding till about the Civil War or so, tariffs were the predominant source of revenue for the United States, at some points accounting for as much as 90% of total federal income. From the Civil War till the early 1900s, that was still the case, with tariffs constituting sometimes more than half of all federal income. But there's a different element to it. And the government chose specific sectors and industries to try to protect and strategically promote. So for that second era, there were 2 elements, still very much the revenue component, but also this desire to strategically promote and develop domestic industries. In 1913, the United States enacted the 16th Amendment, which allowed the government to collect an income tax for the first time legally. Since then, about 1915 is when large amounts of internal revenue, income tax revenue, started coming into federal coffers. And since then, for the last 100 years, the income tax has been by far the predominant source of federal income. Tariffs waned in the amount of how important they were for the government to raise funds, particularly after the Second World War, when free trade was advanced and promoted by the United States, not just to advance its economic interests, but also its geopolitical interests. And that may have culminated in the early 2000s with the ascension of China to the World Trade Organization in 2001. So that's where we have been in the past. Now we're all here to talk about president. I think all that's interesting personally. But ultimately, we're here to think about what's going on today. So looking at this, I'd like to draw our attention to this blue bar here, which is the present day. And we're going to start with this blue bar, not quite the pink line yet. What this blue bar is in the early months of 2025, after the new administration came in, and we're proposing all kinds of different tariffs, some of which covered all imports coming into the US. Some covered just certain sectors like autos or technology or pharmaceuticals. Some were country specific. It was suggested maybe there'd be punitive tariffs on Mexico, for example, and China. If we added all of those up, then what we had been showing for months with this blue bar is what's about the worst case scenario, or rather the extreme case scenario. And we thought it's probably around 30%, which is a huge increase. Now let's take our attention to this pink line here. For months, the market consensus was that this pink line would end up somewhere between 10 or 12 or 15%. So the administration had communicated very clearly that this was a policy that they wanted to enact and that they intended to do so. But financial markets generally expected the increase to rise about 10, 12, 15%, which still, if you look at a long history, would have been the largest increase in several decades. Where we've ended up through last week, and the important point that I want to make is that we have ended up at the top of this blue bar. We have ended up at the highest tariff scenario that was really imagined by most financial market participants as of early this year. So that's the first point that I want to make, is that where we are today is we're looking at one of the biggest changes to U.S. international trade policy, but also economic policy generally. No, we'll stay on this one for just a moment. I have two other points that I want to make before handing it over. So first, this is a very significant shock. Second point is that it is of such large scale that there will be substantial economic impacts. But in my view, it is the size of the shock is so substantial that it's going to be very difficult to parse the economic effects, both in the near and the medium term. So a few things that basic macroeconomic textbook theory would suggest happens after you raise tariffs substantially is, first of all, it's a tax hike. So what we're looking at here is this blue bar before 2025, it's about 2.5%. So the average tariff rate on goods coming from the US in 2024 was 2.5%. That raised about $80 billion in federal revenue in 2024. If trade flows stay the same this year and next year with these new tariffs in place, then that tax hike will rise from $80 billion to $750 billion, which is a tax hike of about 2% of GDP. So what happens when we see that kind of tax hike? That's, first of all, it's an increase in import costs. A tariff is a tax on imports. Some way or another, that's going to make its way fed through prices. The way that we think about this is if an importer now has higher costs, then they can choose to pass that along to their producer prices and their consumer prices, or they can eat it in the form of compressed margin. As it passes through, they also have to contend with disrupted supply chains, modified trade volumes. Do we still want to purchase goods from Vietnam that have a 10% tariff? Do we still want to purchase goods from China that have a 145% tariff? So all this is going to add to a lot of tough decisions, probably increased inefficiencies. But what's even harder than thinking about the direct impacts that I just mentioned, and what makes this very hard, in my view, for forecasters and modelers to present people like us with a good base case, is actually more of the indirect effects. So, for example, I mentioned a firm has to decide, do we want to go ahead and raise prices, or do we want to take this, we want to cut costs, or are we willing to allow this to eat to our margins? So let's say that they decide they want to take the cost cutting approach. What's one of the most expensive lines in the budget? It's obviously headcount or employment. So are they going to do that through reducing wages? Do they think they have the ability to protect their employees with lower wages and salaries? Are they going to cut hours for wage workers, scale back on benefits, or reduce jobs entirely? We can start to maybe get some early views on this through first quarter earnings results, which have been coming in through the week. We're paying close attention to management commentary for how they might be taking early approaches to this. But other indirect effects that matter hugely for the macro picture is, what about the Federal Reserve? What are interest rates going to do? A big shock like this might have offsetting impacts where prices might go up, which makes it less likely that the Federal Reserve is going to come in and save the day with lower rates. But if it impairs the economy, on the other hand, then you have these competing sides to the Fed's so-called little mandate of employment and inflation. And lastly, maybe most importantly, is how long is this going to stay in place? We saw last week that the administration is maybe willing to make some concessions and walk back on some of the policies that they've enacted. Will that be the case a few weeks from now? Will this be around for a year? If there's a new administration that comes around in a few years, then will they stay in place even then? So that's probably the biggest thing that companies are starting to think about is how long is this going to remain in place? And that brings me to my third point, which is even beyond the direct and indirect economic impacts, perhaps what's most important to think about right now is this uncertainty channel. So let's go to the next slide. And just to show a rough measure of uncertainty, if we wanted to quantify uncertainty in the US, then this group of academic economists put together the series called Economic Policy Uncertainty Index, which surveys newspapers and a few other sources to draw words out and create an index of basically how uncertain are things today. That obviously peaked in the first quarter of 2020. And the latest print on the index is showing that uncertainty is basically at those same levels. So what does that mean for the real world? We think about uncertainty as affecting three major channels throughout markets in the economy. First being consumers. When times are more uncertain, consumers might be less willing to make a big purchase. They might become more cautious. They might trade down into lower cost goods. What about businesses? Businesses might be looking to scale back or even curtail investment and expansion plans. They might cut back on or cancel entirely new hiring plans. It's all moving towards lower risk, leading to safety. And that brings us to investors. Obviously, in times of uncertainty, we see investors moving to safer investments, safer assets, moving away from the risks. So now I'd like to bring it back to why we're here, which is to private markets. And private markets are not my background, but a few things that I thought of that might be a good way to start the conversation is how does this macroeconomic uncertainty affect VC funds, portfolio companies, and also how does it affect the customers throughout the economy? Is there going to be an emphasis on cost cutting? What's this going to do to exit uncertainty? Will there be a move towards more capital light or risk averse investments? And maybe interestingly, is it possible that if there's a drive for more cost cutting, then what does that mean for the pursuit of innovation?
Look, it's really unfortunate that we don't have a map of what venture activity during the McKinley administration looked like, because that's what we're hearing a lot from this administration as a whole. However, we do have Amy here, and I think Blake asked a lot of pertinent questions that we would love to get some of your thoughts on before we get started.
Yeah, absolutely. First, let's start off with before we get into AI specifically, just what happens during times of uncertainty, because I feel like it's one thing to not know what's going to happen next in terms of the market. Will we go into a recession, et cetera? But actually, the uncertainty itself already impacts markets. And so a couple of things. First of all, in terms of public markets, the IPO window is just shot, right? Like IPOs are delayed, and M&A, particularly larger M&A from publicly traded companies, are also delayed because they're dealing with uncertainty as well, right? In terms of budgeting, cash flows, et cetera. And so that's the first immediate impact. The trickle down effect is is like a longer period of time. What happens in VC is that it means that, VCs are counting on these exits in their portfolio to happen. And if that's delayed, that means that, everyone has customers and our funders are limited partners from endowments and pension funds, et cetera. And what they'll look at is, okay, yet another year where the VC industry is perhaps, for example, underperforming other asset classes like mid cap, private equity and some of the other ones, right? And so we've already been in a multi-year cyclical sort of rotation out of venture capital. I would say there was an over allocation during like 2021. And what this means is funds will have a harder time raising capital. Smaller funds may actually go out of business. And so there is a longer term effect where you'll see the venture capital industry shrinking from like an extended period of uncertainty, but it will immediately, I would say it's like more of like a medium to longer term impact for entrepreneurs because these fund cycles are very long. Like Menlo, when we raise a round of capital for ourselves, and we're in our 16th fund now, we've been around for 48 years. This is a fund cycle that's going to be deployed over about 4 years, 3-4 years, and the fund cycle is 10 years long. And so what that means is that most of these larger funds will still have a lot of dry powder. They are going out there to deploy this capital in the timeline that they told their LPs they're going to. And so, but in terms of like where will you see shifts away, maybe from venture capital deployment, it is in these very large early rounds, right? You're seeing these billion-dollar seed rounds and AI. I think those will become much harder to raise. And because again, these are very high volatility, very risky rounds. And then the second thing I would say is that there's usually a shift from later stage investing to earlier stage investing, because again, you're like VCs are essentially lengthening the time period to exit, right? And so so that actually benefits most of the people here because I think most of you are looking at raising either a seed or a Series A round of capital over the next 12 months or so. And usually what happens, for example, right around the beginning of COVID, is that large funds actually rotate to more seed rounds, more Series A's. And so I would say like the volumes will probably continue, but in terms of what are people funding, there will probably be a rotation out of high burn categories. And there's going to be rotation into like categories that are clearly being accelerated right now from market demand, right? And that is AI right now, because from like we talk to enterprise customers all the time because basically these are the end customers of our portfolio companies, and when we hear from them that internal AI adoption, like yes, it is partially like to increase like creativity, unlock product features from their end customer facing products, but also it is a huge cost cutting measure right now. And that's why, like, interestingly, we don't actually forecast at Menlo, for example, that AI adoption, even as CFOs in general are pulling back budgets because they're extending, runway, they're actually like probably going to accelerate. Our prediction is that there's going to be an acceleration of adoption of AI tooling across the different functional areas.
Quick show of hands in the room. Who is building something in AI? What would we say? 40% of the room? Okay, great. You guys, you're building in the right space. And as Amy was pointing out, at the end of the day, everyone is clamoring for early stage rounds. So congratulations, you've already raised a round.
Yeah, I would say for non-AI related categories, it's just more difficult to raise capital right now. I mean, we're still funding them. For example, at Menlo, my last raise was literally a mobile games company. They're doing nothing AI related. But we're going to get into this with the fundraise, but you really still, if you're AI or not, you really need to answer the question of the why now. And it's just that story is more obvious if you're an AI native company, particularly in the application layer, so in the enterprise.
I think one of the first questions we should answer is why AI?
Well, so I mean, hopefully everyone here has played a lot with ChatGPT. I mean, I think if you have, and I think they broke something like $1 billion in weekly active users, which is pretty insane stat. It is, I would say like generative AI models, whether it's language or image or video, is really like the most disruptive technology of my generation, at least. I mean, I think I missed the mobile wave as an investor, because that was like when I was more of like an analyst and associate. Thankfully, Menlo did not. But in this sort of the next like decade or so, it really does look like these are what is unlocking the most, different ways of how end consumers or end enterprise are thinking about disrupting like workflows and how they're, living their lives. And because the underlying technology is disrupting so many different use cases and industries, that's why it is really like a technology shift and the order scale, a scale at like, of mobile. And so as a result, we have, let me go to the next slide. Within AI, like we're really looking at the AI stack, because it actually takes quite a bit of like back end infrastructure evolution in order for you to deploy the models at an enterprise scale with the safety in order to actually utilize them for your end customer. That has created an entire stack of business providers and vendors, including the foundational layer, including Anthropic. We're one of the largest investors in Anthropic, and also OpenAI. And then you have the compute layer, which is pretty much dominated by the hyperscalers. Then you have everything in the middle, including infrastructure layers that are really helping you with parsing and storing and cleaning data, vector databases, and piping in data security, data governance, that are really sort of all in sort of service of being able to utilize these models at a production level. And then you have tooling that are sitting at the horizontal and vertical layer. And I would say this is the application layer. So this is kind of above the line. It's less at the production layer, kind of an infrastructure layer, but more like things that actually touch the end consumer and end user. And we think about it in terms of horizontal and vertical use cases. So horizontal being for example, agent architectures that can really unlock multiple use cases. And so that would be like, for example, some of the computer vision companies that are coming out, and then also the agentics or horizontal workflow that are coming out. And then vertical AI use cases are really like very specific. So it's like industry specific. Maybe it's agents that really help the legal industry or the medical industry or the marketing department or the sales department. And these vertical AI companies are deeply embedded in the existing systems that team and that industry is already plugged into, right? And so they're basically, for the most part, I would say innovating less on underlying sort of technology mode and more on workflow mode. And so, maybe like they're plugged into, like for example, Clay, who's actually not in our portfolio, but they are maybe plugged into like thousands of data sources. That's why they do, sales enrichment of data. And that's like an advantage that they have. They're actually not doing anything like fundamentally different from like again, technical mode perspective, but they have workflow advantages.
Amy, you mentioned some of the non-AI companies that you've backed recently. Is there any concern around like a crowding out effect of the sheer volume of capital that's getting deployed into AI? For example, like 60% of the deals that were done in 2024 above $100 million ticket sizes were to AI. We're also seeing the $2 billion seed round from the former CTO of OpenAI. So how do you think about that, like other 40% folks that are building something AI adjacent or maybe not in AI in today's market?
Again, I go back to this idea that you need to be surfing some sort of wave, right? And that's what we're looking for. So, for example, one of the investments that we made last year was Shopify, which is a New York-based company, and they're not an AI company, but they are surfing the wave of creator marketing. As in, as CPIs are getting really expensive in consumer and marketers are increasingly looking at other channels to acquire users, well, the fastest growing channel is actually like influencer marketing. And so they have like a platform that helps marketers actually end to end to manage their hundreds and thousands of creators that they're working with. How do you track the ROI of the spend and the gifting that you're using for them? And so that is like the wave that they're surfing, and why we then see that reflected in their company growth and profitability, right? And so it always translates to a market pull if you're surfing a wave. And so we'll get into sort of like metrics and some of the benchmarking with metrics as you're raising your rounds a little bit later. But usually the two come hand in hand. If the company's growing really quickly, there's some pull going on we're trying to understand what that is, regardless of what the wave the company is surfing.
Yeah, for the record, one of my favorite analogies around VC investing, the wave, the surfboard, the surfer. You need to figure out what the large like macroeconomic or like generational shift is, i.e. the wave. The surfboard being the idea, the application, the product or service. The surfer being the founder, which I think transitions us kind of into what you were mentioning earlier.
Absolutely. So the next few slides is really breaking down the fundraise process, which is why you guys are here today. And I want to make this as practical as possible because I think, in terms of the fundraise process, it's very opaque. There are no rules, but there are a lot of guidelines and best practices. And the thing is, I'll give you guys some numbers. Like as each partner at Menlo, we have 10 partners, investment partners at Menlo. Each of us will probably receive something like 2,000 pitches per year. And then that translates to taking something like 500 meetings. And then at the end of the day, after all the diligence, each partner will only do 2 to 4 investments per year. And so we just look at such a high volume of pitches and fundraise processes. That's literally our job. But the founder may actually only live through 3 or 4 or 5 of these, per company, right? I mean, if you're lucky. And so a lot of what we do with our portfolio companies is really to closely handhold them through the fundraise process so they can get through it as smoothly as possible. And so here, hopefully like impart a bunch of the stuff that I literally tell, all the portfolio CEOs that I've been working with for many years. And then we'll have time for Q&A later on as well, if you guys have specific questions. So the first thing is just mastering the fundraise process. And the reason why I say mastering is so many founders go into the fundraise process cold, and there's no reason for you to do that. In fact, it's probably going to be like a bad strategy if you don't have all the data sort of at your disposal. So the first thing is practice makes perfect. And really I'm talking about your pitch to the investor. And so my recommendation is always, you probably have advisors or maybe even existing pre-seed investors and seed investors. And you leverage this network of yours and also like friends who are founders who have raised money before, et cetera. And use them to first help them craft your pitch, like pitch to them. These are friendlies. Is the narrative resonating? What do you need to tweak? Sometimes our founder is tweaking their pitch dozens of times before they're like live in front of a potential investor, right? And so the first time you pitch an investor should not be the first time you're pitching that slide deck. And as you're creating the pitch, I would say you also want to strategize in your target investor list and get warm intros to every single person in that list. I would say we actually made it to investment committee meeting from a cold outbound outreach just because this company was based in Europe. They didn't have a very strong network. They reached out, the numbers were fantastic. But I would say that's the first time that happened to me, maybe in my entire career. So definitely get warm intros to your entire investor list, but also this is where data is important in terms of what does target list mean? Every investor has their investment theses, their fund only does certain types of investments, stage-wise, thematic-wise, right? And also, and so really understanding the fund. Are they the right fund for your stage, your sector? Is that partner specialized in your sector? Each fund is going to have a lot of partners. Some of these partners are generalists. Many partners are specialists. And so are you getting the intro to the right person, right? And so that's all research that you can do ahead of time. Ask your founder friends. Also, these days, most VCs are online. They have a lot of content that they've released online, and you really should do as much diligence as you can. And I would say most of the founders that are pitching us have done all of this diligence by the time, we're in our first meeting. And
if only there was a friendly neighborhood bank that gave you some of that access and information.
Yeah, the reminder, 50% of our portfolio companies do bank with SVB, so they do have all their intel. Timeline of the fundraise process. So, a lot of founders, even really experienced founders I've worked with, are always somehow surprised that their business metrics don't speak for themselves. And the reality is that VCs are momentum chasing. They're also scarcity chasing. And also like time is of essence. And you basically need to drum up scarcity around your round. And unfortunately, VCs are very susceptible to this. And there are ways that you can essentially manufacture this. And first of all, it is you don't want to like kind of investors will try to meet and get into your process early. But what most experienced founders will do is that they will actually kind of line up investor outreach in maybe a couple of ways and close proximity. And then they're going to drive that to conversions into investment committees and term sheets. And again, like oftentimes you just need one investment committee in order to trigger the other ones that are like interested to converting people. It's hard to get somebody to do first. And it's much easier to get a bunch of firms to follow that. And oftentimes one term sheet will turn into other term sheets, but again, you just need to get that first one. Highly recommend that you use something like DocSend rather than just send out PDF, because then you can actually, you're trying to get as much signal as you can across maybe like the hundreds of investors that you've reached out to, right, for your round. And you want to be able to understand how to prioritize those investors based on their interest. And one of the ways to do it is how often are they interacting with your docs, right? And to do that, you need to be able to track. And so in general, if the VC, if you are proactively reaching out to the investor to ask where they are, they're already telling you they're not interested. So the investor will proactively push you if they are interested. And so those are the signals to just read. A lot of times I find that founders will overly read like signals to the positive. Obviously, founders are very optimistic. And, I'm here to basically tell them like, I'm not like doing, to really just be like that they're probably not showing interest. And even if they are, VCs are great at selling until they pass on you. And so just always, remain paranoid until you have term sheet in hand. Oh shit.
She's just not that into you if it brings
And like I mentioned, if you don't have an AI narrative right now, it is a tougher raise. You're going to really have to explain the why now in your company. And another aspect that I think a lot of founders don't realize is that most deals are actually done preemptively. So like, what does that mean? That actually means you're not actually raising and somebody just is giving you a term sheet because they spent time with you. And that oftentimes triggers a very quick process to be done. I would say that like for Menlo rounds, like in terms of like companies coming into our investment committee meeting, I would say like north of 70% of these rounds have been preempted by somebody. That's how prevalent this is. What does this mean? It means as you're building, some founders are like, I'm not talking to any VCs. And I think that that's probably too extreme. It's good to keep like a handful of investors close. You get to know them over a longitudinal time. They get to know you. These are the people who will likely preempt you, right? A VC that you met for the first time is not going to give you a term sheet immediately. Like, it's probably somebody who's known you for at least 6 months. And yeah, the last couple of things, you just want to get to, you're in a position to negotiate when you have at least one term sheet. If you have one term sheet, you don't have any leverage. And so you're trying to get at least like 2 in order to start optimizing for terms and evaluation, et cetera, and also who you want to work with. And lastly, do your back channel references. So it's also really surprising to me how many founders, it's like the range. Some founders will be like, we'll hear that they've done like dozens of back channel references on me or my partners, and others really don't. The thing is that VCs are really good at presenting themselves. They're really good at selling. That's literally the job. We're like salespeople for the most commoditized asset in the world, which is money. And so what you need to understand is how do they act when things are going well, right? Like when things are going well, every VC loves you, you're getting all this inbound, but like very few people's journey is ever like not ups and downs, right? And so how does your investor act when, the shit is hitting the fan? And that's where you really get back channel references to tell you. And most founders, if they've been through the second, third company, they have a whole blacklist of people they'll never work with again. And it's good to like basically understand what that list is. And so yeah, this is a bunch of, we're going to accelerate the process. Okay, so what's in a typical pitch deck? And this is just a quick, I would say like keep it relatively short, 15 slides. What are you doing uniquely? What's your problem statement? What's your job to be done? a slide usually about the market and about the addressable market, the size of the market. What a couple of slides on your product. What is the solution that you've developed to address this problem statement? Usually I'll get a product demo. Then there's early traction numbers, customer logos. You want that on the side as well. Metrics, anything that you have. Then usually founders, who are the team that you're very proud to have assembled, existing investors, and then usually ends with how much are you raising and what are you going to use that for? So I've got 3 slides that cover seed funding and then Series A for consumer companies and Series A for enterprise companies. So for seed funding, in terms of what are investors looking for at this stage, it's primarily about the founders at this point. And also it's about the founders' thesis depth. So how deep can you go on your thesis for why you're building what you're building? And again, why now? And so some things to really nail in your pitch, right? Why are you the best person to lead this company and build this product? How does your co-founder complement you? If you're a solo founder, that is usually seen as a disadvantage. And so you need to explain why you're comfortable doing this solo versus going about it with a co-founder. And who have you brought and hired immediately to sort of complement you around the team? And then in terms of people have gone to product MVPs much faster now with all of these AI tools, Cursor, et cetera. And so can you demo something? Most seed companies even that I've looked at can at least demo some sort of really basic product or at least show me wireframes on what they're building. How deeply do you really understand your market's competitive landscape? If I'm proactively bringing up your competitors that you have not heard of, is a huge red flag because I spent maybe 10 minutes in your market, right? And as a founder, you're probably living and breathing that. And in terms of, I try to synthesize why are the biggest reasons why VCs are passing in the seed stage. The first and foremost, it's usually lack of founder product fit. You were not able to convince somebody that you were the best person to build this company. That's the number one thing. And I gave a couple of examples. You're building in the application layer, but you don't have any go-to-market experience. You don't have any enterprise go-to-market experience. If you don't have that, your co-founder needs to have that. And then, or you're building in an AI infrastructure space, but you guys aren't technical. So huge red flag, right? So just understand it's about founder product fit. And then it's around usually how clearly can you articulate the thesis? When you've heard 2,000 pitches, you can tell when somebody really nails and deeply understands the market, or if they're 2 layers deep, but not 10 layers deep. So really being able to articulate and understanding a few, several layers deep in your market is really important. Investors do a lot of external references. So when those do not come back positive, then that's usually a red flag, another reason for pass. Now, founders are oftentimes spiky, which means that not every reference is always positive. And it's really important that we're hearing from, maybe you're hard to work with in the workplace. That's fine. That's why you're a founder instead. And so, but we're looking for other things that are red flags. And I would say ethical concerns is one of the biggest ones. And again, not sharp enough by now and be able to articulate that. So here I'm going to go into some metrics because the Series A really is around metrics and growth, and then really being able to articulate the user job to be done and also user motivations, no matter if you're a consumer company or enterprise company.
Just a reminder, you still need to build on all the foundations of seed criteria. It's not like a Series A, founder market fit, domain expertise, et cetera, is thrown out the window.
1,000%, yeah. But usually here, so the first thing is, for consumer companies, consumer founders at this point at the Series A can usually very deeply tell me why are users using them. And they can go very deeply on that. They talk about user motivations, they talk about the different segments of their founders, the user demographics, et cetera. And then in consumer, it's very metrics driven for I'd say most consumer investors, myself included. And so so it's really important to understand the comps of your market and understand what is best in class metrics, right? Because the number one reason why I'm passing here is because the metrics are not there. Consumer companies are usually winner takes most. And so as a result, I really am looking for best in class metrics. I'm not looking for good metrics, right? And so even at the Series A. And so here's some examples where in terms of you're building a consumer social business, very difficult. Like some of the things they're looking for is like down out ratio of 30%. D5 to 7 is like a very popular kind of public company social metric, which is out of the last 7 days, how many users came back 5 days? And so this is like you're demonstrating that your product is like a daily use product, right? And so I'm just gonna skip through some of them. There's a lot of consumer subscription companies. For their, I'm looking at like month 6, month 12 retention rates. I'm looking at monthly versus annual subscription retention. And then we're also looking at like how reliant are you on paid conversion early? I'm really looking at very strong organic acquisition at this point. Not that over 50% of your users were acquired from a paid perspective, unless you're a mobile game, at which the majority of your users will be acquired via paid channels. For there, I'm looking at sort of like D1 730 retention. I'm looking at your ARPDAUs. And so depending on what category you're in consumer, there are like comps that you should be aware of, and the investor will be sort of comparing you to. And a couple of other things. Usually by the Series A, companies will start experimenting with paid channels. And I'm also looking, for example, if you're an iOS, Android app, we're looking into your reviews as well in terms of like, how much do people love your product? And I'll say the next slide. Thank you. Really, on the enterprise side, there's a whole bunch of metrics as well, depending on whether you're targeting SMB customers or mid-market or enterprise customers. I put in the retention metrics that we're looking at, but I would say that in terms of enterprise companies, we're also looking at your payback period. So kind of like what we call the magic number, like LTV to cost of customer acquisition, which to be honest, even at the Series A, a lot of times is founder led. And so the velocity of sales is usually pretty quick still. But as you scale, I would say Series B, Series C, you're going to be scaling your sales team, your go-to-market team, and that becomes more and more important. We're looking at your gross margins, your monthly burn, and so those are all very typical metrics we're looking at, and top of funnel, top of line growth rates as well. We're looking, so at this stage, at the Series A, most enterprise companies really has design partners. There's going to be very few full annual lifecycle renewals that have happened yet. And so we're looking at kind of the strength of the logos of these design partners, and we're going to be calling up most of them and really understanding like why did they select you? What's your win rate compared to other vendors? Who else do they look at? What's their willingness to pay, right? And have you demonstrated any upsell paths with these with the vendors that you're looking at? What's the win rate? Are you demonstrating early that you really understand go-to-market and hiring, and what are the gaps in hiring you need, and what is the product roadmap? So these are all things typically like we're looking for the Series A for enterprise.
But Amy, I thought my co-founder and I were supposed to do everything. So what is the point of hiring all these people?
It's actually a really good point, because one of the big things that happens between the seed and Series A is that the team is hiring usually their first couple of heavy hitters, senior hires. It's actually pretty difficult to do, hiring your first couple. And this is where founders that are hard to work with struggle. And so we really do want to see that you are capable of hiring world-class talent at the Series A.
This is just based off of our market feedback in terms of being able to assess benchmarking points for what you're raising between the pre-seed, seed, and Series A round. So the top line you'll see pre-seed rounds are about $2.5 million and below. Seed is going to be anywhere between 3 and 6, and Series A is 10 to 20 million and up. Oftentimes the type of investor that you're going to be talking to, depending on the round, is very different. For pre-seed, it's going to be angels, friends and family, incubators, et cetera. For seed, that's going to be a mix of some institutionalized capital, but also angel groups and other sort of high net worth individuals. And by the time it comes to Series A, those are all kind of bona fide venture capital firms. The dilution metrics are also just something to be aware of. I think oftentimes, as is understandable, founders are very, very, very dilution sensitive. So being aware of how much you're getting diluted in each round in terms of what the market benchmarks are pretty important. Generally, across all three categories, it seems like 10 to 15% is fairly standard. Although, given what Amy was saying earlier, with a lot of the capital that's coming in at the seed round, we've actually seen that dilution range be a lot wider, from 15 to 25%, depending on what it is that you're building. So this is what I call the speed run portion of the presentation. So think of these more as flashcards and personal reminders that are building off of what Amy said. So number one, pick the right time to raise. No one wants to talk to you on vacation, as great as your idea is. So that's something to be aware of. July, August, December, bad. As much as VCs like to tell you how hard they're working on X, there are certain months that are just going to be unresponsive.
Definitely August.
Next is understanding what your sales funnel is. Again, the whole process of you only need one term sheet, but in order to get to one term sheet, given the fact that Amy, for example, is talking to 2,000 founders a year and is only going to fund 2 to 4 companies, it is in fact a numbers game to a degree, and it's about finding qualified leads that will then become your lead investors. Next is the quality of investors. Again, understanding the space that you're in, who is invested in that space. One of the other points that I think is very important to note here is that oftentimes VCs are not going to be writing checks into companies that are competing with what is already in their portfolio. So being able to understand who else has gotten funded and by who is going to be really important in understanding what your actual addressable landscape is of venture dollars raised. Next, start with a lead investor. There's a reason they're a lead investor. A lot of what lead investors are going to be doing at that point is helping make introductions. They're going to help you reach out to some of your first customers, and will probably help share like operating frameworks of what makes sense for you. Check size is very important, but the quality of that lead investor and what else they're bringing to the table is equally important. Align with strategic angels. The whole point here is that you should never go into a pitch unprepared. Strategic angels are usually a different type of group. They're not institutional investors. They might be high net worth individuals or folks that are smaller check size writers that end up having a different framework than what institutions are offering. They're a very, very, very good group to think about during your pre-seed and seed round, and often are also going to have introductions to larger institutional investors for you to be aware of. Not all intros are made equal. Again, the whole concept of lukewarm introductions, preempted term sheets, that is a very real portion of the market. As much as we like to think that venture capital and success is meritocratic, a lot of it is also who you know. So being able to suss out the quality of the intro is going to be very important to gauge your quality of success in being able to fundraise.
I would say one exception on the weak one, other VCs that passed, is that, so for example, Menlo mostly invests in Series A and beyond, right? Every once in a while, I will still like take a seed pitch as well. And usually I'll be like, this is too early for us, but then I will introduce them to other seed funds if I really think they're like a great company that I am truly tracking, right? And so I'd say that's like the only time when you're talking to a fund that's actually a different stage than probably what you're at, those intros are okay. But if they're actually investing in your stage, that's a negative signal.
Yeah, because at the end of the day, it's about getting the conversation continuing to roll, right? So if one particular venture investor says no to you, it's important to understand why. Use that as part of your feedback loop and either figure out a way to keep the conversation going elsewhere or to figure out when the right time to reapproach that investor might be at some point in the future. I think this stuff we've actually already talked about in terms of how to prepare for the meeting. We just mentioned this serendipitously. It's like I made the deck. And the last bit here is just a couple of resources that we actually have available for you. If you want to be able to understand what needs to go into the pitch deck and build on what Amy had mentioned earlier, we do have resources available online. And in addition to that, we do have other resources that we wanted to point out. Number one is our Nexus platform, which is an invitation-only platform specifically for pre-seed and seed and Series A businesses that are SVB clients, where we end up introducing digitized investor introductions based off of what the underlying metrics of the company are, with qualified investors that are in fact fundraising and on the platform. Following that, if you would like to be keeping up with Blake, Phil, and Brent and the insights, the macro insights for the First Citizens Wealth team, Making Sense is a written commentary that is emailed to you regularly. You can use this QR code to keep up with what FCB Wealth is doing.
Yeah, we're putting out materials throughout the week, throughout the month, along with ad hoc written work. We publish one-pagers every single day. Last week, 4 o'clock, we put out the monthly webinar, and we call it Making Sense for a reason. We're not forecasters, we're not making projections. We're trying to help our clients and colleagues be equipped to make better decisions.
Yeah, I think it's plain English oftentimes, right? Which you don't end up seeing in a lot of macro commentary. And just a reminder, this is not investment advice. That's about it. We do have about 5 minutes left, and depending on what the schedules of our esteemed guests is, they might stick around for a few minutes. But let's just open up the floor for questions.
So out of 2,000, we're picking two. One to two.
Something like that, yeah. Maybe 2 to 4 investments per year per partner.
What are top three achieving meetings? Top three.
Founder, number one, right? Everything about that founder, what they did before, like, you know, how they, everything. And then usually it's a thesis area. It's like a thesis area that I'm actively pursuing. And the third one's probably the metrics.
So I think concept being important, it's not just founder market fit, it's founder investor fit too.
Hi, my name is Khan. I'm also a bit of a venture capitalist. I had a question. What are the different examples of preemption, or I guess getting a VC to preempt you? Are there ways, or the tactics, and like that? Do you think?
It's the most sort of, I would say, so the question is, how do you get someone to preempt you? And a lot of times it will happen if you have a fantastic quarter or something like that, right? Like, you know, you blew your last quarter out of the water. You sent out an update email to like a lot of the people who are on your email list or something like that, and that might trigger something. But generally, the preempt is not something you can control. Like that investor is like, you are the right fit for them. They love you. This is in their funds like thesis area. They're looking to back some company in that space, and they believe that you are the winner in that space. That's usually the criteria that is happening. And if you kind of prompt them, hey, if you're interested, that's not a preemption. The preemption is like when the investor is doing with when you're not raising.
I think another thing to kind of be mindful of here is like some of the words that we're using have like a one-way connotation, right? Pitch, you're going to convince somebody else to do something. But one of the points that Amy is, I think, kind of subtly made is like, there has to be a fit between both parties. It's more like a dance or a date where you realize like, I can be with this person for 5, 10, however many years it takes for me to realize an exit, maybe forever, depending on what markets look like they do today. But it is something to be weary of and to understand. Like, I understand that term sheets are very hard, fundraising is difficult, but at the end of the day, you want to be able to do that with someone that is adding value and is kind of buying into the vision that you are presenting. Big question over there, I think. Yeah.
So when I first started in the investor space, I was told that, you know, if you had 10x in 5 years, that was considered good. Right now, it seems like with AI and with all of this disruption, that is no longer a good metric. What would you consider to be a great metric?
That's a good question. So we're seeing the most insane growth right now because, again, AI demand is being pulled forward. And so we're seeing metrics like 0 to 10 million in ARR in 1 year in terms of growth. I would say that's like best in class that we're seeing. And we're also seeing kind of like 0 to 3, 0 to 5 more frequently than not. Pure enterprise go-to-market, probably more like 0 to 2, 0 to 3 because it is heavier sale. So the 0 to 5 and plus, like we're seeing more like prosumer, PLG kind of motion companies. And then the Series B's, I mean the best in class there is like 5 to 30, 5 to 40, right? Like, and so you have to really understand like how fast are these companies growing right now that are commanding such crazy rounds. It's because they're also growing at unprecedented growth rates as well.
You mentioned founder investor fit. I worked in kind of an ancient industry of social media. So there's a lot of people that have experience in social media, but they've moved on. You work in AI. Which are in trying to find the right investor? Are they people that work in social media or currently in social media?
So the question is like, how do you find the right investor fit in social media? I would say almost all consumer investors I know who are my peers and competitors will look in that category. They are the biggest companies in the world, right? And so, but the problem is there just hasn't been one since TikTok. And so it's an extremely, extremely high bar to get over the line on social networks right now. But investments are being done, right? In social messaging, we did one last year called Days. And then, you know, there's other ones as well. And so it's still getting funded because of how large the upside is in the category.
Contrarian thinking, it sounds like we're due one. So last question.
So if you're not in tech, but you built platform that has a built-in AI tool to help basically facilitate the user's engagement with the site. But this tool, this AI tool also doesn't exist anywhere else yet. Like, is that serving the way?
I feel like if it's like if it's generally like AI is like a very general wave, and so I think we need like a lot more specifics on who your actual target audience is and then the market to really know. But it's all in how you're crafting your own narrative, right? You should craft it towards one of the waves that are happening.
One more question from online, if that's okay?
Yeah, good.
Perfect. So for Menlo, specifically, outside of the capital that's being invested in the company, what makes you guys a good partner? What are other services you do for your portfolio companies?
Yeah, that's a really great question because the thing is that the company that we're term sheeting probably has a lot of other funding options. And so we spend most of our time selling ourselves. And I'll just tell you a couple of things that stands out because we're multi-stage, right? But so how are we different from other multi-stage firms? I would say that it really comes down to deal volume. So when my last year at Lightspeed, I had been part of and helped like lead 15 investments. And the thing that you cannot scale from a partner's assets is their time. And so Menlo specifically has a smaller portfolio. That's why we only do 2-3 investments per year. And I am truly on texting basis with my founders probably every other day right now. And we do everything from like hiring to business development, partnerships. We introduce customers to them. Obviously we're very, very hands-on when they're fundraising. But the only way we can actually provide that service is if each partner doesn't have a very large portfolio. And so I would say we strive to be the most impactful board member of companies that we are serving. And I would say that's probably the biggest thing that helps us stand apart. I'll say one more thing is we co-launched a fund with Anthropic, and we're the only VC fund that's done that. And so it's a $1 million fund called Anthology, and we use that to do actually like pre-seed, usually AI infra deals.
As someone who's only recently been texting with Amy, I think the memes are a high value add. Just want to throw that out there. I don't think it's a Menlo thing. It might just be an Amy thing. With that, I think we're going to conclude the webinar. Thank you everybody who joined today. I saw we get 100. Thank you everybody in the room. We're going to stick around for a few minutes in the adjacent space where food was getting served. So I think we have this space for about another 15 or 20 minutes. So thank you again to our guests, Blake and Amy, and thank you to all of you.